Man, hey, listen, this has been a very interesting day. Welcome into Market Takes. Thank you everybody for joining us. I know you could have been anywhere in the world and you are here with me. I'm your host, Dion Rabowen, right here on Market Takes on YouTube. You know we do this every Fed meeting when the FOMC gets together, when Fed Chair Jerome Powell speaks. I appreciate you being right here as we break down everything that happened in the meeting, after the meeting, what we heard from the statement, all of that good stuff. We are doing all of that today right here on Market Take. So thank you very much for joining us. Look, today we are going all the way into this FOMC meeting. We're going to unpack the statement. There wasn't really a lot of change in the statement to unpack, but there was a lot to say about what happened in the markets after the statement came out and then after Fed Chair Jerome Powell stepped to the podium and started taking questions. So we're going to dig into all of that. We're going to talk about the rate decision, of course, and how that aligned with expectations. Also going to talk about the outlook for 2023, because 2022, for all intents and purposes, as far as the Federal Reserve goes, that's basically in the rearview mirror now. We're looking forward to 2023, and we're going to talk all about that. Of course, we're going to check in on the markets, talk about how markets reacted, stocks, bonds, FX, of course, crypto and commodities. We're going to talk about what all those did and what those moves mean, and really kind of break down and get into that. And of course, we're going to talk about the chairman's press conference, and we are going to talk about what comes next as we again look out into 2023. So thank you again for being with us right here on Market Takes. This was a big one. The Fed raised rates by 50 basis points. That was largely in line with expectations. The rate now going up above 4% on the federal funds rates. We're just, if you followed us, if you've been here on Market Takes, you know that's going to increase the rate for credit cards, the rate for auto loans. All those things are going to get more expensive now because the Fed has raised rates again. Hopefully you got one of those high yield savings accounts. Your rate is also going to be going up pretty soon if it hasn't already. But this met with market expectations. The market, after that CPI report that we got yesterday, Consumer Price Index, the inflation report, had priced in a 50 basis point increase after 4 straight 75 basis point increases that we'd gotten in the last 4 meetings from the Fed. Now they've decelerated to 50, but that was really pretty priced in. That had been kind of what the market was expecting overwhelmingly. And one thing that I really thought was very interesting about what Fed Chair Jerome Powell said during his press conference was that the Fed needs to see inflation, quote, or needs to see, quote, substantially more evidence that inflation is on a sustained downward path. What was most important about that? Substantially more evidence. The market really reacted pretty strongly initially after we got that CPI report, but then we closed the day just a little bit higher, and what we've seen today, the price action after the Fed movement, signals that there is a lot of uncertainty in the market. We're going to get into all that in just a bit. The Fed also raised projections for the Fed funds rate in 2023, that's next year, by around 50 basis points to about 5.1%. So the new summary of economic projections shows that the Federal Reserve expecting to raise rates a little bit more in 2023 than they had at their last SEP, which was in September. So the Fed saying, you know what, we're going to have to probably do a little bit more. We expect more rate hikes. And the market's reaction to that was, okay. Anyway, we are going to get into all that, just what we saw that tells us that the market didn't really buy into what the Fed was trying to sell. Right now it seems like we're seeing a bit of a grudge match between what the Fed says and what the market does in reaction to what the Fed is saying. So today I think was a great example. The Fed chairman really came out and again told the market we are going to keep working until this job is done. He has said that at the past few meetings. That's kind of become his rallying call. We're going to keep raising rates. Again, use those words. We need to see substantially more evidence that inflation is on a sustained downward path. And he even said today, we think the appropriate thing now is to move to a slower pace. That's the idea, but he didn't say we're going to stop raising rates. He didn't say we're going to lower rates. He said we're going to keep raising at a slower pace, but that slower pace got a lot of folks got a lot of folks excited out there in stock land, and in bond land, you saw some really significant moves as well. The market seems to still be right now pricing in not a slower pace of hikes, not higher rates for longer, which is what the Fed is saying. The market seems to be pricing in that Powell pivot. The Powell pivot being a reversal from rate hikes to lower rates, to rate cuts. And that's not what the Fed's saying, but if you look out at Fed fund futures markets, if you look out at short-dated treasuries, if you look out really even the stock market a bit, investors are saying very clearly with the decisions they're making on what they're buying and what they're selling, that we think the Powell pivot is coming, and that could mean one of two things. It could mean that the Fed is just saying these things because they're trying to affect the market and the market doesn't believe them. It could also mean that the market expects there to be a recession that would force the Fed's hand and really force the Fed to have to start cutting rates. So again, what a lot of folks think could be happening is that the Fed wants to keep raising rates, wants to keep rates high, but because we have this painful recession, that's going to force the Fed's hand. And even though Fed Chair Jerome Powell has said, we plan to keep raising rates, we plan to keep rates high as long as it takes to get inflation down, even if there's economic pain, even if there's a recession, the market is saying, no, you're not. So that is definitely something worth watching. Powell has been very explicit on this. He's said it, and he's come kind of short. This meeting was interesting because he didn't bang the table like he has the last few meetings. Previous meetings, he was beating on the table, beating on his chest. Let me tell you something. We're gonna keep rates high. This time it was more like, hey, listen, baby, here's what we're about to do. We just want to keep rates high. It's important to us that we get inflation down. And the market seemed to have taken that tone to mean, all right, they're not serious. Want to read you a couple quotes from some investors who I've spoken to and who've kind of reached out and been talking in media, things like that. The first one is from Josh Jamner. He's the investment strategy analyst at ClearBridge Investments. He talks about the CPI report that we got yesterday, which showed CPI rising at 7.1% year over year in November. That is a big move down from 8%, big move down from 7.7% where we were the previous month, and a big move, from that 9.1% rate we saw in June. But Jamner says, quote, the slowdown in inflation appears to be more driven by post-pandemic normalization finally playing out, more so than it looks like the 425 basis points of rate hikes the Fed has implemented taking effect. Basically what he's saying is what a lot of economists have been saying, that these effects on inflation are going to sort of peter out of the economy naturally because those supply chains are going to get fixed. It just took longer than the Fed expected. And the declines that we've seen in inflation aren't really a result of the Fed raising rates. You see that more in things like housing and food and things like that. They're more just a result of the economy sort of getting back on track and getting its footing and things moving more in a normal way. He says, quote, this is actually fairly concerning because the lagged effects of Fed tightening are still looming in 2023, and the economy appears to be slowing on its own, lending to elevated recession risks in our view in the coming year. That basically is what investors are sort of going back and forth on right now. And apparently what the Federal Reserve and folks on the Fed board are going back and forth on right now. Is the economy slowing down enough on its own that the Fed doesn't need to do much more to act to bring the economy back into focus and to bring inflation down? Or does the Fed still need to keep its foot firmly on the brake and really try to choke off growth so that we can really get inflation under control? And that's the big question that we're seeing and that really wasn't answered. Fed Chair Powell made clear his statement and his sense on this, but a lot of investors saying, we don't believe you, you need more people. And that's very interesting. James Knightley, he is the chief international economist at ING, said soft U.S. inflation will reinforce the view that the interest rate peak is in sight. But having been hurt by the, quote, inflation is transitory narrative, the Fed will be wary about a conviction call in this environment. There's less chance of a rate above 5% in 2023. He says recessionary forces will mean rate cuts are on the agenda in the second half of 2023. And that's really where you have it. Folks believe the Fed is going to have to cut rates in 2023 and that the Fed's hand is going to be forced, that you get rate cuts. Well, rate cuts mean stock prices are probably going to go higher. It means that it's more a signal to the market that the Fed has their back, that they're going to push more money out in the economy. They're going to stop doing what they've done The Fed has not said that. They've said the opposite, but the market thinks, listen, I'm seeing CPI, I'm seeing what's happening with these, purchasing managers index reports, I'm seeing business surveys, I'm seeing the housing market. Those all say to a lot of investors and economists out there that the market is, and that the economy, it says that the economy is in trouble, the Fed is going to have to respond, and that rate cuts are on the way, which is a reason to be bullish. The stock market buying it a little bit, but not really all the way on board. You're seeing a lot of things, which is why you're seeing the stock market kind of doing like this and bond prices really jumping up and moving higher, especially on the longer end, because folks want to buy those bonds because they're worried about this recession that they think they see coming up in 2023. That's really what you're seeing kind of across markets. And it's interesting, the Fed Chair Powell really didn't respond very strongly to those worries about recession because, again, he wants to convey that the Fed is very clearly committed to getting inflation under control no matter what. Now, former New York Fed President Bill Dudley, he was on another station talking about this and talking about the market reactions. And what he said I thought was very interesting. He said, quote, "When the market ignores the Fed, that puts pressure on the Fed to do more." He says he is surprised that the market isn't taking the Fed a bit more seriously. A lot of that has to do with the fact that the Fed has very clearly responded to the market over the last few years. In March 2020, the Fed responded with the largest, most significant policy response ever when markets sold off. In 2018, the Fed reversed course on previous rate hikes and started cutting rates in 2019 after the stock market sold off. So the market has in its head that if things get too much worse, if things get bad, the Fed is going to step in and reverse course and cut rates, and that's what you're seeing from market expectations right now. So as we look out on WSJ.com at the market reaction right now, we are seeing stocks a bit lower. You really have seen a yo-yo from the markets. The S&P, the Dow, the NASDAQ all really have, initially when the statement came out, they moved lower. Then you saw as the press conference went on, they jumped higher. And now we're seeing a little bit lower, but not near the lows of the day. I think the real interesting moves you've seen have been in the bond market, where we're seeing yields now moving lower than where they were. Again, there was expectations after the CPI report that inflation longer term would be lower than it had been, that growth would be lower than it had been. And after the Fed came out with its report, you saw yields jump up higher. Then they kind of came back down, and now they're actually lower across the board from 1 year to 30 years. And you're seeing, initially the reaction after the statement was released was bond yields jumped higher, especially at those shorter dated yields, 1 year, 2 year, 3 years. Those jumped by 10, 11, 12 basis points initially. Now they're lower, and we're seeing the 1 year and the 2 year down by 13 and 18 basis points, leading the charge lower, the 10-year yield down by about 14 basis points right now. This is a very interesting reaction because, again, you're pricing in it. Really, I think the market is saying the Fed could see a recession coming and could be inducing a recession, that it's going to be more painful or longer than really a lot of folks are predicting. That's what you're seeing in the bond market. The stock market as well seems to be a little bit more concerned about the potential for a painful recession. We saw stocks fall last week, reversing those big gains. Remember, we saw big gains in October, gains again in November, and now we're seeing that momentum kind of fall out of the stock market. A lot of folks were expecting the Santa Claus rally or a Powell Claus rally to come in and lift stocks higher through the end of the year. We may not be seeing it as some of these recession fears really start to grip the market. Another thing you definitely want to watch out for is currencies. The dollar has started to turn down. That's the one place where you've kind of seen some consistent bullish momentum. As these bond yields have come down, bond prices have gone up, the dollar has come down with them, and that could actually help out the stock market as the dollar falls, because a lot of those companies do business in other countries. When the value of the dollar is high, when the dollar is strong, it reduces how much money they're able to make overseas, because when you change it back into dollars, you get less money back. So we're seeing the dollar down again, about 0.5% down versus the euro. The WSJ dollar index down about 0.25%. The overall US dollar index down about 0.35%. As we look out into commodities, another place where I think it's very important to watch, we're seeing crude oil futures up almost 3%, and we're seeing gold right now down about 0.4%. Copper, another thing that you watch, is copper is up about 0.4%. Really big moves we've seen in oil and copper, I think the two most economically sensitive commodities. Oil, we have seen positive now. It just turned positive recently. It's positive by 3% for the year, but over the past, oil had turned negative for the year just recently, and over the past few days, we've seen prices pick back up. Oil now is up 3% year to date, but it has dropped 13% in the past 3 months. Copper, aka Dr. Copper, because it is a barometer for the health of the economy. Dr. Copper is like that doctor checking your temperature, telling you, how you doing? Doing not so great, down 13% year to date, but over the last 3 months, it's up 10%. And I think a big part of that has been in the last couple days as these bullish expectations for lower inflation have really bolstered that trade for copper. As we're looking out at crypto, the cryptocurrency market, you're seeing things kind of pretty even keel. Bitcoin up 0.28%, Ethereum up 0.7%. Crypto is still in that space where, this thing with Sam Bankman-Fried is going to tell folks a lot about what goes on in the crypto space. Coinbase now, really kind of ratcheting up its advertising and things like that. It'll be very interesting to see what happens in the crypto space because we haven't seen a huge sell-off. Crypto markets really responded pretty significantly after that statement from the FOMC, and we have not seen that bounce back like we saw in other markets. So crypto investors really not, feeling the same thing or that same response from the Powell press conference that we saw in other markets. Listen, what we heard from Fed Chair Powell today, he says that we're going to keep going until the job is done. The market's saying, we don't believe you. And another part of this, again, we talked about maybe some turmoil or some discord at the Federal Reserve. It's all about the hawks and the doves, right? The hawks want to keep rates high because they believe that you've got to tamp down inflation. That to be the most important and really your first, second, third priority is to get inflation under control, and nothing is more important. The doves, they're more worried about economic growth, more worried about some of those inflation fears. And this year we're gonna have more doves than hawks on the board. However, the hawks occupy some of the more important positions. You've got Fed Chair Powell, who has long been a policy dove, but is kind of turning towards the more hawkish side, and he's the chairman. You've got Fed Governor Wallard, you've got New York Fed President Williams, who is one of the more important chairs. He's actually the vice chair on the rate setting committee, even though Fed Vice Chair Lael Brainerd is the official vice chair. So on the dove side, you've got Vice Chair Brainerd, you've got new Fed governors, new Boston Fed President Susan Collins, new Fed Governor Lisa Cook, new Vice Chair for Supervision Michael Barr, Fed Vice Chair Lael Brainerd, Philip Jefferson, and Michelle Bowman. So a larger number of people on the dovish side, but more important people who have more influence, maybe more sway on that hawkish side. We will see in 2023 what comes of this kind of discord we're seeing, because the doves are worried. They're saying we might have done too much already. If we keep going, we might do way too much and really hurt the economy more than is necessary. The hawks are saying, no, we've got to do more. We've got to tamp down and kill inflation so it doesn't destroy the economy and really do long-term damage. We're going to see how that goes, and the data will tell us a lot more about that in 2023. So what comes next? Here's what you need to look out for. Retail sales. U.S. retail sales is out tomorrow, and their expectations for that report to be negative. Look out for that report, because that could actually, a negative report could be bullish for stocks and risk assets. Be sure you watch that. Existing home sales. We will be right here a week from today on Market Takes, breaking down the existing home sales report, talking to you about what's going on in the housing market, how the Fed is affecting that, and how that's affecting the overall economy. So join us for that. Be there or be a... And of course, it's going to be all about these Fed speakers. Be sure you're watching out. The next report is Friday. San Francisco Fed President Mary Daly is going to be talking to AEI, a Washington, D.C. think tank, leans on the conservative side. Check that out. I think that will be very instructive about what she's thinking. She's one of those policy doves that has been on the committee for quite some time. And so it'll be interesting to tap in with her after the speech from Fed Chair Jerome Powell today and see what she's thinking. Listen, that's going to do it for us here on Market Takes. Thank you so much for being with us. I am Dion Rabowen. I've been your host. Thank you so much for being with us. And we hope you'll be back with us next week when we break down existing home sales. And yeah, we'll do it all again there. Hope to see you.